Good afternoon. I want to thank everybody for logging in and calling in today to our webinar that we have today on private placements. It's a lot of the webinars that we do here at Advanta IRA center on real estate or private notes and private lending, but we're kind of switching gears a little bit today and talk more about private placements. And we've got a couple guests on today with us who are going to share more about their expertise in dealing with private placements and also kind of what you need to know before you're investing in those kinds of deals. And as we go through the presentation today, for anyone who's listening live to the webinar, if you have any questions for myself or for our guest presenters today, please type those questions into the chat box on your screen. If you're watching the recorded version of this webinar, you can certainly jot down the information for myself and our guest presenters and reach out to us with any other questions that you have. My name is Scott Maurer. I'm the Director of Business Development for Advanta IRA. I'll be the host today of today's webinar. I've been with the company for a number of years, focused primarily now on helping individuals to open new accounts, understand the rules that are involved with self-direction, and get them started. And a lot of what we do at Advanta is education. For instance, the class we're having today. So part of my daily responsibilities and weekly responsibilities are also to teach classes to individuals as well. Really trying to spread the word about what self-directed IRAs are and what you can do with these types of accounts. Now just a bit about Advanta, for those of you who may not be familiar with us. We are a self-directed retirement plan administrator. We work with clients all over the country. We don't sell any products. We don't give financial advice. What we do is provide great customer service for people who want to invest in different types of assets within their retirement accounts. So people who have 401ks, IRA accounts, and you're looking to invest in something, maybe it's not traditional, whether it's not a stock, it's not a mutual fund, it could be a piece of real estate, or it could be a private placement like we're going to talk about today. That's what we specialize in doing, giving, like I said, great customer service, especially a lot of experience in this particular industry. We have over 20 years combined experience in the industry, and I think one of the big selling points that we have, and I think what people like about our service, especially our clients who are using us, is it's very personal. We have each new account that we receive gets assigned to one specific account manager. That's one point of contact for you with anything you need regarding your account. You're not calling an 800 number and waiting to talk to the next available representative. You'll have the name, direct number, and direct email to your personalized, to your personal account manager. So we've had a lot of great feedback on that, and people have found that very useful over the years to have that kind of good touch point. Again, at Advanta IRA, one of the things that we are big proponents of are being educated. Today's webinar is just one of many different educational events that we do throughout the year. Self-directed IRAs, a lot of people are either new to it or they know a little bit about self-direction, so they always need more information to either help make decisions on whether or not to move forward with a self-directed IRA or even kind of to find out what a self-directed IRA is. So we provide the webinars like today. We do live lunch seminars at our Tampa and our Atlanta offices. And we have a YouTube channel with all the recordings from all the past webinars that we've done over the years for you to participate in. Some of our classes and some of our webinars are based strictly on self-directed IRAs. And a lot of times, though, like we're doing today, we like to partner with professionals in different areas who can share their expertise and their knowledge on issues that are kind of related to self-direction. As we talk today, we have a lot of clients who have invested in private placements over the years. So that's why we've brought on a couple gentlemen today to talk about their experiences and what you really need to know about investing. So again, for those of people who are not sure what a self-directed IRA is, most people who have a retirement account, you have a 401k, maybe a 403b or an IRA, they hold those accounts with brokerage firms or banks that offer them limited investment options. So you have an account with a Charles Schwab, or you have an account with a Bank of America, you're limited to investing in those assets that they sell or that they are willing to hold. But IRS regulations allow for a very, very broad range of different investments. In fact, the only two things you can't invest in with an IRA is you cannot purchase life insurance and you cannot purchase something that would fall in the realm of a collectible, like artwork, antiques, things of that nature. So outside of those two kind of exclusions, there's a lot of different assets that you can invest in. Just most people haven't heard about it because, again, their IRA, their 401k, is held by a firm that is offering them only a limited investment products. how Advanta is different is that we allow you to invest in all of these alternatives. We are willing to hold those assets and do all the reporting that goes along with those particular accounts. I mentioned we do, and if you look at our webinar history, we do a lot on people buying rental properties and real estate or investing in private notes and mortgages. But today's class, we're talking specifically more about private placement. So I kind of wanted to give an overview of some of you on the webinar who might want to know, what am I talking about when I'm talking about a private placement? Private placements include various types of REITs, or real estate investment trusts, that can be either public or private. People invest in hedge funds. People invest in venture capital firms or startup companies. A lot of these firms are either set up, or these investments might be set up as an LLC or a limited partnership in which your IRA is maybe buying a piece of a whole. So you could have, for instance, a real estate development firm that is raising $10, $15, $100 million in capital for their project. Your IRA can buy kind of but a piece of that. Again, so these are what kind of private placements are. Private stock, individuals, again, starting up companies might be issuing stock in their company to any potential investors. So, a private placement really defined, it's basically stock or ownership interest that's offered from a company, typically to a smaller number of investors. Sometimes there's the requirement that each investor be accredited. That's something more specific to each individual private placement. But the key thing all of those investments have in common, again, because they're private, they're not publicly listed, they're not publicly traded, and thus it's hard to make that investment into an account like with a Fidelity or with a Charles Schwab. They don't typically allow for that type of an investment. So some of the terminology, that there's paperwork involved when individuals are investing into private placements. There are PPMs, or private placement memorandums. Typically, this is a thick document. It's a comprehensive overview of the investment that you're considering. Probably identifies who the principals are, what the overall business plan is, how investors will be paid back, et cetera. So that's a document certainly that you as the investor are going to need to review, and in the case of Advanta, you would sign off that you have reviewed that particular document. There's also operating agreements, which are documents that state maybe how new members are to be admitted, how the LLC or the partnership is going to be operated. And some private placements have subscription agreements. It's almost like an application to be an investor. So if I wanted to invest $100,000 into a private placement, they might have a document that they ask me to fill out, giving them a tax ID number, my name, et cetera, to actually buy those shares. When you work with Advanta, if your IRA is looking at making an investment into a private placement, we do work with you on all of these documents on this slide to make sure they get properly titled in the name of an IRA. So our job at Advanta will be to facilitate moving your funds from your current account, if you have a Schwab or Fidelity account, transferring that money over tax-free to an Advanta account. And then from there, you tell us what you want to invest in. We will make sure the paperwork all gets done correctly and is properly titled so that all the benefits from your investment come back tax-free or tax-deferred into your IRA account. Now, one key thing that we don't do at Advanta is we do not do due diligence on investments. So when we talk about private placements, we help you process the paperwork, but it is up to you as the account holder to make sure that you have performed proper due diligence on a particular company. Again, it's not going to be something that we do. So that's why we've invited Randy and Scott today, Randy Domolky and Scott Shetter from Private Access Network, and they're going to talk more about how you do due diligence on these particular types of investments. They specialize in this field, and so I thought it would be great to have them come on, because if someone's evaluating a private placement, kind of what should you look for? What are some general principles that should guide you? Again, as we go through the presentation today, if you have any questions, please type those into the chat box. We'll make sure we get those asked. Randy and Scott, are you guys there?
Absolutely.
Yes, sir. Ready to go.
All right. Well, I'm going to turn the presentation over to you guys. I might pipe in with a question or two here and there, and certainly, again, if anyone has questions that are listening to the webinar, get those typed into your chat box. But Randy, Scott, I'll turn it over to you.
Great. Thanks very much, Scott. I'd also like to welcome everyone to today's webinar on due diligence for private equity investments, and thank you for taking the time to listen. I'm your host, Randy Domolky, and I'm the co-founder and managing director at the Private Access Network. I've been private investing for 18 years, and I've been public investing for over 30 years. And I also spent 12 years in the telecom industry as a finance and a general management executive. I'm also joined today by my partner, Scott Shedler, who will say a few words about himself.
Hi, everyone. Yeah, I'm Scott Shedler. I co-founded and alongside Randy as managing director at Private Access Network, or PAN. I spent the bulk of my 30-year career as a chief financial officer or general manager at various divisions of GE, and then I went on to the Motley Fool, where I did similar jobs. I performed due diligence on probably hundreds and maybe thousands of deals, whether they're projects, potential acquisitions, or business development partnerships. And I formed the Private Access Network with Randy over 3 years ago, and I have been involved with him in due diligence on many hundreds of companies since then. So I'm really looking forward to talking to you guys about how we do due diligence on our high-growth emerging technology companies today.
Great. So what we're going to try to do for everyone, and again, I encourage you to type your questions in, over the next approximately 30 minutes, we'll do our best to walk you through what we've learned in our 60 years combined of executive business management, public and private investing, and all different kinds of investment and acquisition due diligence so that you're better able to do this on your own. Before we get started, we'd just like to tell you a little bit about the Private Access Network so you've got some context. And again, I'll turn it over to Scott for that brief explanation.
Yeah, so at PAN, we believe that investing in private companies provides investors a great opportunity to realize outsized profits, but that it's difficult to do and time-consuming. So what we've set up a model that gives accredited investors the positive attributes of private investing without all the negatives. Basically, Randy and I do all the work. We screen all the deals, and we make the decision about which deals PAN members can get into. So PAN members have the ability to get into our deals on a deal-by-deal basis, if they opt in based on the quality of our write-up. Randy and I are always the first money in. We're always principals, never brokers. We put our own personal money into every deal. We always invest alongside other smart money. We're not the only smart money in the room. And typically that's other venture capital companies with institutional investors as clients. And as I said, you get to invest on a deal-by-deal basis for a relatively modest quarterly membership fee. And we set up our pricing model in such a way that we only win when you and or your clients win. So we think it's a great model, and it's working well for us, and we're having a lot of fun with it.
Great. Thanks, Scott. Just one more piece of background information. If you'd like to find out more about the Private Access Network, you can check out our website at privateaccessnetwork.com, or if you'd like to send us an email, you can send it to either sshedler@privateaccessnetwork.com or rdomolky@privateaccessnetwork.com. So, why is everyone here today, and why do you care about private equity due diligence? Well, you may not know it or not, but private equity has returned approximately 500 basis points over the S&P 500 on a 20-year basis. So that's 5 whole percentage points every year over 20 years. You can imagine how much that adds up to, and I would suspect you're here to learn how you might be able to get some of those returns for yourself or for your clients. And let me also mention that venture capital, which you can see on the slide, hopefully, which is a specific kind of private equity investing, has returned over 1,500 basis points over the S&P 500 on a 20-year basis. And again, that's annualized over 20 years. So you can imagine the difference that would make in your earnings. And I'll just, of course, mention the caveat that number one, that's an average, and number two, no individual person is going to be able to perform the average. So you might do better, you might do worse, but it is an extremely encouraging average, which is, one of the main reasons that Scott and I are doing this, and we've been so successful with our client base. In terms of what we're going to cover today, we've already talked about the background on our firm and on what private investments are. We're going to walk you through a definition of due diligence. We're going to talk about the golden rules that we use to perform due diligence. We're going to discuss human nature and how that plays into due diligence. Then we're going to talk about some quick examples of human nature and how that influences due diligence in what mostly is a negative way. We'll reveal the secret sauce that PAN uses to conduct its own due diligence, so you want to make sure you're still here for that. And finally, we'll summarize what we've talked about and hopefully what we've learned. So again, if you have any questions, please feel free to type them in and we'll try to address them as we go along. So you've probably all heard that the three most important criteria in real estate are location, 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 right? Well, in private equity, we believe the three most important criteria are due diligence, due diligence, and due diligence. How do we know this, or why do we think this? Because the Kauffman Foundation did a study in which they tracked the returns of over 500 angel investors that invested in over 1,000 private companies, and they concluded that the amount of time spent on due diligence was the behavior that had the greatest positive impact on private company investment returns for investors. That's significant. I mean, they looked at hundreds of factors. They determined that due diligence was directly proportional to outcomes. In fact, when they split the sample in half between investments where investors had conducted less than 20 hours of due diligence and more than 20 hours of due diligence, they found that in the upper bracket, investors realized a 6 times return on their money, whereas in the lower bracket, they only realized an average of 1 times return on their money. So that's remarkable. Just think about that. By doing more due diligence, on average, you can increase your returns by 6-fold over the lower due diligence scenario. So that's remarkable. And what do Scott and I learn from that, of course, and we're hoping to pass the learning on to you. Of course, what we've learned is that you should do as much due diligence as reasonably possible for any particular investment in which you're considering an investment. Now, what really is due diligence? That's what we're here to talk about, and I'll just give you a high-level overview of what we define as due diligence. We define due diligence as asking every possible and relevant question, reviewing every existing and relevant document, and performing whatever kind of analysis that we think is necessary to determine whether a particular investment meets our investment criteria. A little wordy, but I think you'll see what I mean by the time we get to the end. Now, I talked about rules, right? Everyone's got to have rules. Due diligence is no exception. We have some rules that we're quite proud of, and that we believe we do a good job sticking to. So the first rule we like to follow, you've probably heard this before, he with the gold makes the rules, right? So what does that mean? In this case, you, the investor, you're the one with the gold. You're the one with the money. You're the one who's considering putting your capital, which might be your savings, might be your child's college fund, might even be a state pension plan where you work, into a specific investment. You're the one that makes the rules. You can ask any question you want that appears reasonable under the circumstances. If the answer to one question creates 3 more questions, that's just fine. Because remember, you have the gold, you make the rules. Rule number 2, it's all relative. So what do we mean by that? We mean that the data points in and of themselves are not particularly meaningful. You may have heard the expression that 1 is a point, 2 is a line, and 3 is a curve. This quote applies to private equity due diligence very aptly, because a point and a line are somewhat meaningful in terms of your ability to draw investment conclusions. What you want is a curve. You want a multitude of data points that you can analyze, and you can figure out the rate of change in these points over time so you can make the most informed due diligence decision. The third rule, don't let emotions get in the way. As you probably know, this is a good rule to follow generally in life, And as you'll see later in the presentation, emotions are the enemy of good due diligence. Rule number 4, it's about the money. And this ties in, very nicely with the golden rule as well. You're making an investment. Don't be ashamed of asking tough questions and being critical of the answers. While the usual rules of please and thank you still apply, you should feel free to repeat your questions when they are ignored, or if you get less than complete answers, absolutely follow up until you're satisfied with the answer. If you get vague answers to specific questions, say something. Again, nicely. What we believe, and it's more than belief, we've determined from our years of experience, is that the meek and the shy will end up with lower returns than the bold and the assertive investors. So be assertive, ask as many questions as you possibly can to reasonably determine whether an investment is good for you. And don't let the people presenting to you get away with less than complete answers. So
hey, Randy, Randy, this is Scott with Advanta. I got a quick question going back to your last slide there. Just curious, you mentioned kind of it's about the money. Does that kind of, I don't know how often, you probably don't deal with it as much, but investors themselves might come into a situation where they're looking at the investment from a social standpoint. I want to make a socially useful investment, something like that. Does that tie into that? Because obviously when you're investing, it's about making money. It's not about necessarily social good. Sometimes they tie together, that's great, but is that something you all ever see on the end? People want investments to be made simply because they believe in a product, necessarily whether or not it's going to be profitable.
Well, so we're focused entirely on making profitable investments, Scott. But what we find sometimes is that companies are catering more to a clientele that might have a social mission, or even catering to investors that have a social mission. So we need to ferret that out very quickly in the process. We're all for making the world a better place. We're all for social good and charitable organizations, but that's not what we do. Although I would tell you, Scott, right? Whatever your criteria is, social, profit-oriented, you should be as diligent as you can to figure out if a particular company or investment is aligned with that strategy. So many of the techniques we're talking about today would apply if the goal is the best socially responsible company you can find. You would just have to replace some of the words and language I'm going to give you with something that would be more appropriate for the social companies.
Hey, and let me just add to that, and I don't think this will surprise anyone, that there is a significant overlap between the money-making companies and companies that are making the world a better place. I'll just give you two examples. We're invested in one company that makes it easier through an Uber type of business model for families that need in-home care for their loved ones to find excellent caregivers. And then secondly, we're invested in a company that does augmented reality for industrial applications that make industrial workers that need to use their hands, need to use both hands to get their jobs done, much more productive. And in both cases, the world is a better place as a result of what these companies are doing. So it definitely overlaps.
Great, thanks. So let me get to the fifth rule. This is a really good one. In fact, it's so good you saw it on the front of our presentation. You might have heard about that book, Getting the Yes. We like to look at it as getting to know, right? We are trying to figure out how quickly we can exclude a certain investment from consideration. If we've exhausted all our questions and we love all the answers, that's the yes for us. So it's a different mindset than, how do I get this company into my portfolio? We're asking ourselves, how can we rule out this company or investment? Because we know that 97% of the investments we look at are not going to meet our hurdle rates, are not going to meet the private access network guidelines. So, we're not hurrying people through the presentations, but we know that almost in every situation, an investment is not going to be a fit for our very high standards that our investors are holding us to. So we look at this as a getting to know exercise more than it is a getting the yes.
Cool. So let's real quickly review what we've gone through so far. First of all, private equity returns can significantly exceed public market comps. Second, due diligence is by far the most important factor in determining the return on any specific private investment. Third, due diligence is any and all research that you believe is appropriate for the situation. And then fourth, there's the golden rules. Leave with the golden rules to make the rules. It's all relative. Don't let your emotions get in the way. It's about the money, and it's mostly about getting to know. And it's especially if I add this phrase, it's almost always either no or not now. So good. Thank you for that, and I'll turn it back to Randy.
Sure. So far, we've talked about quantitative aspects of due diligence, right? Ask a lot about the numbers, calculate even more numbers, analyze all the numbers you have. Sounds easy, right? Not quite. I mentioned emotions in the last section, and it's such an important topic for successful due diligence that I want to explain in some additional details the negative influence that emotion and other human factors can have on successful due diligence. So what do I actually mean by human factors? The good news is we are all bright, adaptive, and capable human beings, right? But the bad news is we are also all emotional, approval-seeking, and insecure human beings at the same time. As a result, there are many different emotional traps that can eat away at the potentially even ruin your due diligence efforts. So what are some of these behaviors? Loss aversion, and you can see these all on your screen. Loss aversion, this refers to the behavior of expecting unduly high returns with disproportionately low risk. You can see how this would be bad. If you are inaccurately handicapping the risk, you are inadvertently taking more risk than you should, and you may be paying more for securities than you really should be. And the point here, with this being what I'm calling a, quote, human factor or a part of human nature, is you may be wired as a human being to make this mistake. And so you may have to just consciously ask yourself, am I falling into the trap of loss aversion? Second, narrow framing. This behavior refers to making decisions without considering all the implications. We just told you, take into consideration as many data points and issues as you possibly can. But again, some people fall into the trap of, oh, I'd rather, take a shortcut, or I'd rather take the easy way out. What we're saying is be cognizant that that's a possibility and do everything you can to avoid it. Anchoring is when you use familiar experiences to evaluate an investment, because again, we all like to be in a familiar environment. However, you do that even when those experiences are inappropriate for the situation. So you feel comfortable just because you're in a comfortable situation, but then you're drawing an inappropriate or an inaccurate conclusion, and again, you may not know that's what's going on. Mental accounting is taking undue and excessive risk in one area and avoiding rational risks in the other. So you're keeping kind of a balance sheet of risk, except you're overweighting the things you should be underweighting, and vice versa. So what else? Herding, and you can learn, this whole chapter is written on all these factors. We're just trying to give you a high-level overview in the short time that we have today. Herding is copying the behaviors of others. We're all probably familiar with this, even in the face of unfavorable outcomes. So similar to groupthink, which I'm going to get to in a minute, you are essentially following the leader, and that may not be a good idea. Media response means reacting to news without reasonable expectation. Again, you see things on TV, you may place an undue emphasis on that news. You don't know where it came from. You don't know if that person's done their proper due diligence, but because you see it in some kind of recognized media that you're used to, you may place undue emphasis on it. Optimism or over-optimism is believing that good things happen to your portfolio and that bad things happen to the other guy's portfolio. Again, you want to avoid this. Groupthink is when a group is so concerned with maintaining consensus that they fail to evaluate all their options. So similar to herding, you may be afraid to speak up in a group environment. There may be dynamics of leader, follower, boss, worker that prevent the group from really making what is the optimal decision. So let's talk about some examples, because maybe it wasn't entirely clear from those brief definitions. Number one, let's say, for example, you're looking at two deals where you can only invest in one of them. Instead of investing in a really cool and cutting edge, what we would consider really cool and cutting edge augmented reality or virtual reality company, you invest in a trucking company because it seems less likely to fail. Well, you might be right that it's less likely to fail, but you've essentially locked yourself into a low return. So going back to what I said at the beginning of the presentation about potentially realizing 500 to 1,500 basis points of extra return every year, because of human factors and human nature, you may have locked yourself into a low return. If you want the high return, what you should have done is invested in the augmented reality and virtual reality company. And again, as we know, that return is not guaranteed. But the point is, in the trucking company, there literally may be no prospect of a high return, and you don't realize that you've fallen into that trap. An example of herding, let's say the markets are hot, you're feeling pressure to make investments, and you see everyone else is investing in food delivery companies, something that's actually going on today. And you assume that that's the thing to do because everyone else is doing it, and they must be smart, and they've likely performed tons of due diligence. They're professional investors, they're wealthy people. They must have looked into this for months. Well, as it turns out, in this hypothetical scenario, which is not far from the truth, food delivery turns out to be highly competitive, margins get squeezed, prices collapse, and you may lose your money. So what's the learning there is perhaps what you should have done is to act independently, ignore the crowds, and make sure you did all of your own due diligence in the ways that we discussed in the first section of the webinar. So lastly, in terms of the third example of the human factors, let's say all your partners want to invest in a software company run by a fraternity brother that they all knew in college, and you knew him too. You know that this person cheated their way through college, but you're too afraid to tell your friends and partners. What potentially happens? The P&L forecast drastically underestimates the future losses, company runs out of cash, fails, and you lose your investment. You should have spoken up. Groupthink was your downfall in this example, and you need to avoid things like that.
Cool. So now that we know about the human factors, what can we do as far as best practices to enhance our due diligence? First, identify the helpful and potentially harmful human characteristics of investors. Discuss and socialize this with all the stakeholders. Be cognizant of these qualities when you're making your decisions. And then, of course, communication. We'll encourage everybody to raise objections and voice concerns. And Randy and I definitely have a devil's advocate process before we say yes to any deal, just to make sure that we don't let ourselves fall into any of these traps.
Great. And I just want to emphasize one thing that Scott said, which is this idea of being cognizant of the qualities. Be cognizant that we're human beings with pluses and minuses. Be cognizant that the due diligence process in and of itself is long and arduous. And that's your first step towards being successful. It's people that don't know about their own weaknesses who are more apt to fail than someone who does and can use what I would call a countermeasure to offset something that might ordinarily be negative. So again, be cognizant about all these things, be on the lookout for these kind of traps in your own due diligence, and you're going to be so much more able to be successful and not to particularly fall into these traps. So as I said in the beginning, yeah.
Randy, if I can interrupt, I have a quick question again. I encourage anyone who asks questions to get them typed in. You mentioned one of the things in human nature potentially problematic is optimism, the thought that nothing bad happens to me, that happens to everybody else. is there an equal kind of on the other side where people can be too reluctant if they are a pessimist, where they feel that no matter what I do, it's never going to be successful? And how do you counter that kind of thinking to actually, for someone to say, well, I knew I need to make an investment, and kind of realizing that not everything necessarily bad happens to you if you do your proper due diligence?
Yeah, so that's a really good point, right? So, we're all, many times, right, again, we're human beings. Sometimes you're afraid to hear the answer to certain questions. When you look into an investment and that investment is actually a good one, you hear great answers to your questions. So, this is the kind of thing, again, people are afraid to raise their hand in class, in high school. Raise your hand in this case, because it's likely that something you might be scared of or be concerned, that it's got undue risk. When you actually ask the questions and hear the answers, you might be pleasantly surprised, and that's going to make you sleep very well at night when you make a certain investment. And of course, if the answers are bad, you're going to sleep very well at night knowing that you didn't make the investment. So yeah, I would say that's a double-edged sword. And in our case, in our view of the world, knowledge is power. There's no limit to the amount of knowledge you can get about a particular investment. And similar to the real estate analogy, you want to do all your work up front, right? Because there's little you can do to influence these companies once you become an investor.
And Scott, I'll add that I'm getting a little echo there. But I'll add that we do something that I sometimes call a pre-mortem, and that's identifying the ways that we could lose, and putting a name to our potential pain. What would have to be true for us to lose our money, and then we articulate all those. We actually write them all down, and then look at them and say, are all of these risks individually and cumulatively, are they tolerable for our investment thesis? But that helps to really get past the emotional level of pessimism and or optimism by really being articulate about the different ways that we might lose if in fact we're going to.
Great. So as you can see on the screen here, and as I promised at the beginning of the presentation, we are going to tell you what our secret sauce is. We have no problem telling you. We're happy to share it with you. And I can tell you that it is no more complicated than we are going to explain to you today. And we'd be happy to have anyone, use what we're telling you, mimicking what we're doing, and trying to make your private investments just as good as they can. And I'm going to ask Scott to talk about the specifics for you.
Right, yeah. So every deal that we decide to invest in PAN has these 5 things in common. First of all, an enormous market opportunity. You guys can imagine the size of the market in home health care. It's at least $24 billion, and the growth rate is also enormous. And in the augmented reality case that I talked about before, there's 20 million deskless workers in just the U.S. alone. Second, the company has a credible plan to capture and defend its share of that market as they grow at 10x and then 10x again. So what we look for is a business model that is resilient, typically with some aspect of recurring revenue, and growth strategies that make sense. So again, number 1, huge, enormous market opportunity. 2, credible plan. 3, a bright, highly experienced, dedicated team that is very candid with us and also very empathetic with the problems of their target customers. 4th, and this is one that a lot of investors are just more hopeful about and tend to ignore on the way in, a target-rich environment for potential exit events at valuation multiples that will generate very attractive returns for investors. And then the secret sauce of the secret sauce, so the creme de la creme, so to speak, for PAN is traction. So we look for traction with real live customers before we invest in any deal.
Hey, gentlemen, we had a question pop up, if I can interject. Someone said your slide, that one of the first slides you shared indicated, venture capital returns considerably higher than private investment returns. Assuming, I guess, the person's asking, are the risks proportional then to the returns of venture capital as opposed to private investment? And maybe how do you evaluate the differences between the two?
Yes, that's a great question, Scott. So as you would expect, you don't get something for nothing in this world. And venture capital tends to be way more volatile than just regular plain old private equity. So the rate of failure in venture capital is very high. If you start a business from scratch, the very likely scenario is that company goes out of business. And that's why it's so important that we're so scrutinous in the companies that we look at. On the other hand, once a company has, 40, 50 million in revenue, maybe even 100 or 200 million in revenue, you're still very far away from going public, but you're also unlikely to fail at that point. Now, it doesn't mean you can't fail. It just means, maybe there's a 10 or 20% chance of failure, whereas with an individual early stage startup company, it actually might be 80 or 90% chance of failure. And so the successful people who can navigate this minefield will make more money in venture because they've essentially taken on that risk of failure. And so you do have to ask yourself, in return for the opportunity to make that much higher return every year over 20 years, am I willing to take the risk that I don't do that well and I actually have a much lower return than I would in general private equity or public equity or bonds, or again, there's a whole continuum of safety that you have to deal with. So yeah, no, that's a good point, and that's exactly the situation that if you can successfully navigate and take more risk, you will absolutely be returned based on historical averages with a much higher return.
Yeah, and I guess one more question following up.
Sure.
I'm going to bump the slides back one just so I can point out my question.
Yeah.
Are there one of these 5 criteria that are more important than the others, or conversely one that's less important? If you don't get a satisfactory answer to that one, the other factors may make up for it.
Yeah, so all of these factors, Scott, are what we call necessary but not sufficient, right? So you really need all of these things. I would say the one that is the most fungible in a way is the traction, because that can be measured in a lot of ways. If you have 100 customers, that's different than 1,000, but that doesn't mean it's bad, right? So traction is a much larger continuum than some of these other things. We're way less likely to compromise on the large opportunity and the credible management team and the exits, which tell us how we're going to get our money back. But if you are merely early in the genesis of taking a large market share and a large opportunity, we're much happier to discount for that than we would any of the other factors.
Okay, and another great question came in. Said, do you all look for a minimum potential ROI for your member investors?
Yes, absolutely, and I'm going to let Scott handle that because he came up with the formula.
Yeah, well, there's two things. Yeah, we definitely are targeting in the mid to high 30s for all of our wins. And so when you couple that with the fact that we expect to lose sometimes, we know that this is not a zero risk game. That we think that'll combine to create a IRR for our investors in the 20% range. But a simple way that we look at it, that's a rule of thumb, is we want to earn X times in X years. So we want to earn our investors, say, 3 times their money in 3 years or 5 times their money in 5 years. And that's very, very similar to the 35 to 40% IRR for our wins. So we make sure that those types of outcomes are very reasonably possible before we put our money into a deal.
Yeah, and one follow-up, somebody said, when you talk about those mid-30s ROI, what time frame is that? Is that a year? Is that 5 years? 10 years?
I think we coach our investors to think about a 4 to 7 year time frame. And again, we make sure that that's reasonably possible before we invest. Do we think there are going to be outliers where somebody gets acquired in 2 or 3 years? Yes. Or somebody takes 8 or 9 or 10 years? to get the exit, that's possible too. But 4 to 7 is probably the sweet spot.
And Scott, let me just clarify that that's 30% every year for the life of the investment. So it's not a it's not a one-time return of 30%. It's a goal of every year making 30% on that investment, and it happens that the formula we talked about, the X times our money in X years, roughly equates to about that 30% internal rate of return every year, no matter how many years it is. So let me just mention a couple things about traction for any physicists on the phone with us today. I really like what Isaac Newton said about traction, when he said that objects at rest tend to stay at rest and objects in motion tend to continue in motion. So while I said traction comes in all sorts of different flavors, the one flavor we do not invest in is no traction at all. And that's exactly for what Isaac Newton says, is that when you're at rest, when you have no revenue, when you have no customers, when you're not in business, it's just very hard to break out of your own gravitational pull. That is the hardest part of starting a business. And as a result, it's a risk that is the hardest to evaluate and discount for, that someone or some business will go from rest to motion. And if I continue with the physics analogy for a moment, because it really seems to work here, you want to see businesses with a balance between potential energy and kinetic energy. So a balance between huge market potential, but killing it from a traction point of view.
Cool. And just a little bit more specifics on how we handicap for traction. First of all, we need to see a fully functional product. Second, that has real live paying customers. Third, that is getting those customers through a repeatable marketing model. And fourth, if they're getting those customers in such a way that they're at least growing and ideally accelerating. If not only if there's no traction at all, that's bad. But also if they're flat, that tends to be scary, and typically that ends up in either a not now or a dead on no for us. But those are the key elements of traction that we hold ourselves accountable for at PAN. Good. So I think we're getting to the home stretch here. So let me just summarize what I think we've covered. First, private equity investments offer high ROI opportunities to investors. In some cases, as much as 1,000 basis points over public equity comps. Second, investors must have a specific and measurable company screening and due diligence plan if they expect to achieve those outsized returns. Third, investors must be disciplined, and they must be thorough when applying their due diligence plan to prospective companies. It's better to ask a tough question than to suffer the sting and potential embarrassment of a loss. Fourth, don't be afraid to say no. It's almost as important. It's probably at least as important to say no to the bad deals as it is to say yes to the good deals. Fifth, remember the human factors and act accordingly. And last but not least, really dig in using all that data and context that Randy talked about earlier to make sure you understand what the real rate of traction is in the business that you're looking at. And I think we're done.
Yeah, well, that's it. We're finished. We'd like to thank everyone for their attention. We'd like to open up the mics to questions, and we'd like to encourage anyone, as you see on the screen, to contact us via phone or email or website. And Scott and I are always happy to talk about due diligence, private investing, private access network, anything, any and all things investments. We're happy to talk about. So with that, I'll just turn it back over to our host and thank everyone for participating.
Yeah, and I just want to pile on real quick to thank Scott and Advanta for hosting us today. It really is nice to be working with you guys.
Yeah, I appreciate that, so we have time for some questions. If people want to get some more typed in, I had another one came in said they wondered if you have had a significant number of investors using a self-directed IRA to invest through your deals or not. Was a question somebody asked.
Sure. So, Scott, so far we've had less than 10% of our members which are using self-directed IRAs. So it is, people are doing it, but it's far and away a minority of the members that we have in Private Access Network. But that's part of the reason we're doing the webinar today, because it is no extra work for us to have self-directed IRAs. And if that makes it easier for someone to do business with us, then we'd love to have them.
Yeah, and one of the follow-up to that question might be something I could take. Someone said if the investment is in a trade or a business, is the IRA return subject to UBIT tax? Which I don't know, Randy and Scott, if you're aware, that UBIT is a tax that applies to IRAs when they're invested in businesses. But I think that's more of each individual what you're investing in. But if you're investing into a C corporation for tax purposes, UBIT will not apply. If you're investing into a partnership for tax purposes, then that's something you need to consider, I think. I don't know if you want to add anything that's fine, but I mean, that's going to be investment specific.
No, you're spot on. So it's UBTI, unrelated business taxable income. And you're right. In a C Corp, there should be none of it. And that is why we make sure that all our companies are C Corps, because any of the taxation is done at the corporate level. So the operational profits are not being passed through to the members. This is being treated as a capital gain. And so we didn't get into that, but this is a very tax efficient way to invest, because you get tax-free compounding for the life of your investment, and then you're paying a long-term capital gains rate on the back end.
Right. Another question came up. How much has PAN and how much have you guys invested to date, and what is the size of maybe a typical company that you invest in?
Sure, absolutely. So we are participating in rounds of investment that are anywhere between 2 and 20 million. So that means that a company is raising either what we call Series A, Series B, or Series C rounds of private investment stock. And so far, PAN has been participating in amounts that have been in the low hundreds of thousands, as high as $1.4 million out of those particular rounds of funding. And so as we grow, the amount of money that we're putting into those companies will also grow. And again, as those companies grow, and this is one of the unique features of PAN, but as those companies grow, and they might be raising even, tens or hundreds of millions of dollars, PAN has a front row seat at those financing events that we can allow our members to access through the network.
And Randy, I think Scott also asked about the size of the companies that we're investing in. Their revenue has ranged from 1 to 30 million per year, and I think the employee base is probably 10 to 75. Just give you an order of magnitude.
We have one more question. I think we might shut it down after that. We're getting close to the time. But the question, I think, is a good one. If the business you're evaluating does not have much outside information or third-party information, what do you guys do? What do you all do to verify what you're being told by the company?
Sure. So this is a really good question, Scott, because it kind of highlights a bunch of the things we were talking about. So first of all, we do not force ourselves to make an investment decision based on, unverifiable information or a small amount of information or suspect information. So if a company, basically just says, you got to trust me on this, we're the next Facebook, our answer is no. Our answer is no, we don't trust you in the sense of, without verifying what you're saying. And so if someone cannot independently validate, or we cannot easily independently evaluate what they're telling us, we just put it on the back burner. If the story is exciting, we're not necessarily going to rule it out, but we're going to wait until there are things like brand name paying customers that you can just, with the company's permission, pick up the phone and give a call to and verify what they've told us.
Yeah, and I'll pile on two things. One is that we in our network, and I suspect a lot of the folks on the call have similar situations, there are a lot of domain experts in our network. So if we need to validate that something that the company said, say in the energy industry, we call the energy experts in our network to say, hey, what do you guys think about this? Secondly, as I said, we always invest alongside other smart money, and so we'll find out, what information they got to validate what the company is saying. And then third, I'll just pile on to the traction point. It's great to have paying customers, and we talk to them as well.
Yeah, and actually, I lied. We have two more questions. I think they're short ones, and then we'll end it on that. Someone wants to know if you have a minimum investment. And then also, do you originate the placements, or do you just, you get into something that's already invested? I think you guys aren't starting the private placement itself. You're looking to invest into them.
Yeah, so I'll take the first question. Scott can take the second one, or vice versa. So, yes, almost all of the investments we make are as part of a syndicate. And syndicate's a fancy way for saying there's somewhere between 2 and 10 total professional investors in the deal. And we are likely not the firm who has set the price or the other terms for that particular investment. But at the same time, most funds are not taking the entirety of a single investment round. So there again is 2, 3, 4, sometimes 5 or 6 professional investors that are participating in the round, and we are one of them. The unique thing about PAN is we're probably the only investor, and this is really borne out, that in most cases we're the only investor that can allow a new member to invest in a very specific deal at that time.
Correct.
And do you have a minimum investment?
Yeah, so what we do is we set up special purpose vehicles for every deal we do. People opt in on a deal-by-deal basis, and we did not want the minimum to be a problem. So they can get in for as little as $5,000 per deal, but many of our guys have invested hundreds of thousands of dollars in a deal. So it's a big range, but there's effectively no minimum.
All right. Well, gentlemen, I want to thank you very much. Great information today on this webinar. I'm sure everybody that participated live got it. Got a lot of it. I'm sure those listening to the recorded version as well. Just great information. Randy and Scott's information was on that last slide. My information was more towards the beginning if you need it. If you have questions on investing your IRA and how the process works, please reach out to me. Again, my name is Scott Maurer with Advanta IRA. And if you have questions on evaluating investments, you want to learn more about what Randy and Scott do, please reach out to them as well and find out more about what they do. So, Randy and Scott, thank you again for joining us today.
Pleasure, Scott. Thanks for having us.
Yeah, thanks so much. Enjoy the rest of the day.
Thanks, you too. And again, everyone who's listening or recording or live, please make sure to tune into our next webinar. Thank you.